Okay, just wait 1 minute for everyone to reconnect. Okay, so let's try to understand where we, yes, we are recording. So once again, we have three types of operations: sell or purchase securities, and the third operation is sell or provide or only provide the discount loan. And if the bank repays this discount loan, then the monetary base decreases. And if we just provided this discount loan, the monetary base increases in dollar amount again. So let's compare what we see here. Compare open market operations and discount loans. How can we deal with those uh, two types of operations by the Fed? So open market operations and discount loans, they both change the monetary base. And the Fed has greater control over open market operations than over discount loans. Why is that? Because the bank may choose to repay the discount loan at any time, but only Fed can choose whether to buy or sell securities. And the Fed can completely control the volume of open market operations, because only Fed can initiate this purchase or sale of security. Not the bank, but only the Fed can do that. And once again, the Fed is buying or selling these securities by having the trading desk at the New York Fed place orders with primary dealers. So the Fed goes to these primary dealers, of course, electronically, and say, okay, I would wish to buy 1 billion worth of securities, treasury securities, and these dealers will connect to the banks and asking, there is the deal, and you may sell some securities because the Fed needs to lower the monetary base. So the Fed's control over discount lending is much less complete. Um, the Fed has some control over discount loans because it sets the discount rate, which is the interest rate the Fed charges on discount loans. In fact, this discount rate differs from most interest rates because it is set by the Fed, whereas most interest rates are determined by demand and by supply in financial markets. So this is different interest rate. The discount rate and the interest rate, these are a little bit different. So once again, the Fed decides what discount rate to charge the banks, and the interest rate by itself, it depends on the financial market health. As a result of the difference between the Fed's control over open market operations and its control over discount loans, economists think of the monetary base as having two components. And we can see it in this equation. We can express the monetary base B as uh, B known is the non-borrowed monetary base, and BR the borrowed reserves. Okay, so B is monetary base, non-borrowed and borrowed reserves. So borrowed reserves is the same of discount loans. We can see it over here, so everything is okay. This is this is it. This is the three operations you have to understand. And if anyone asks you how the central bank can change the monetary base, you can say sell or buy treasury securities and provide discount loans to banks. So these are three options to change the monetary base by the Fed or by the central bank. Next, let's look at the simple deposit multiplier and how to use the T accounts to illustrate that. We now turn to the money multiplier to further understand the factors that determine money supply. And we uh, have to understand what is the multiple deposit expansion. Multiple deposit expansion. What happens to the money supply when the Fed increases bank reserves through an open market purchase? And to answer this question, we first analyze the changes that occur at a single bank and then look at the changes for the whole banking system. So we start from the small and try to expand this to the whole banking system. How a single bank responds. Suppose that Fed purchases 100,000 in treasury bills from Wells Fargo, increasing its reserves by 100,000. We can see this in the first T account, the increase in reserves. The Fed's purchase of these T bills from Wells Fargo increases the bank's excess reserves, but not its required reserves. Required reserves don't increase because they are determined as a percentage of the bank's checkable deposits, and because this transaction has no immediate effect on Wells Fargo checkable deposits. It does not change the amount of reserves the bank is required to hold. So Wells Fargo earns only a low interest rate from the Fed on the additional reserves obtained from the sale, and therefore has no incentive to loan out or invest these funds. Because generally in normal conditions, if we say, we as a bank, we have sold these securities, we received these excess reserves, so now we have $100,000. Why should we put all these dollars to the Fed and just receive 0.75? Instead, we can provide the loan to some person and receive maybe 2% on this loan, or maybe we can invest it somewhere and receive maybe 3%. It doesn't make sense to place all the reserves, all these $100,000 to the Fed. So suppose that Wells Fargo, there is some kind of the Rosie's Bakery, and Wells Fargo loans this 100,000 to Rosie's Bakery to enable it to buy 2 new ovens and maybe something else. We will assume that Wells Fargo makes the loan by creating a checking account for Rosie and depositing the 100,000 principal of the loan in it. So both the asset and liability sides of Wells Fargo balance sheet increase by 100,000. So what can we see here? It provides the loan, so it opens the checkable deposit account and places 100,000 there, and reserves, not the reserves, but the loans are increased on this same kind of value to make the balance sheet equal. Recall that the money supply using the M1 definition, it equals currency plus checkable deposits, okay? And if the bank lends money to Rosie, well, so this bank creates checkable deposits, and therefore it increases the money supply. Once again, so before that, we were talking about only monetary base. So now, by after this open market operation took place, after the bank sells its securities, receives $100,000. Now the bank doing its own business. It provides the loan, and by providing the loans, the checkable deposit account rises, and that means the monetary supply it increases. So this is what happening, and the same kind of thing might have happened throughout the whole banking system in the economy. So we can see that each time the bank provides the loan, the checkable deposits increases. Okay, then next, the Rosie by herself. So after Rosie received, it spends the loan proceeding by writing a check to for 100,000 to buy ovens from from Bob's Bakery Equipment. So Bob's deposits this check in its account in another bank. Let's see PNC Bank. Once the check has cleared and PNC Bank has collected the funds from Wells Fargo, then Wells Fargo will have lost 100,000 of reserves and checkable deposits. So what is happening after the Rosie wrote check and check is cleared? So securities and loans, it was the same kind of thing which happened after the initial open market operation. And by providing reserves and checkable deposits, we can see that these are just the numbers which were created by providing the loan. And when the loan is used, is taken by Rosie, these reserves and checkable deposits, they are going down to zero. So this is the first just the first step inside the economy. So bank provides the loan, the person takes the loan and buys something. Wells Fargo, is it satisfied? Yes, it is now satisfied because it has exchanged some of its low interest treasury bills, bill holding for a higher interest loan. So definitely it is really beneficial for the bank to sell securities and provide the loan, especially if the Rosie's bakery is good business and it will definitely repay the loan. How the banking system responds with an increase of reserves? We can trace the further effects. So we are continuing this line of events. Open market operation, creating the loan for the Rosie. Rosie took this money and bought and provided the check. The check is cleared, and now what we can trace. Now we are going from Wells Fargo Bank to the PNC Bank, which cleared the check for the Rosie. PNC Bank, after it has received the check for 100,000 from Bob's Bakery Equipment and cleared the check, collected the funds from Wells Fargo. So its reserves and checkable deposits plus 100,000 both. PNC deposits and reserves have both increased. For simplicity, let's assume that when it received Bob's deposit, PNC had no excess reserves. And if the required reserve ratio is 10%, PNC must hold 10,000 out of this 100,000. So this exactly happened. These checkable deposits remain the same, but the reserves now divided to 10,000 of required reserves, and the rest 90,000 the PNC Bank can change to loans or to other operations. So the other 90,000 of these reserves it has gained are excess reserves. Okay, so all reserves, as we remember, divide by required and excess. If required 10,000, then excess is 90,000. So PNC knows that it should assume it will lose reserves equal to the amount of any loan it grants, because the amount of the loan will be spent and the funds may be deposited in another bank. So PNC can only safely lend out an amount equal to its excess reserves. Okay, and now we make, as the PNC Bank makes 90,000 loan to Santiago Printing to purchase the new office equipment. Initially, PNC's assets and liabilities were 90,000 and 90,000, but PNC's asset and liabilities, they rise by 90,000 because these 90,000 loans goes to checkable deposit in SunTrust Bank, and bank creates the 90,000 reserves equal to the checkable deposit amount. When SunTrust, of course, how it happened? Because SunTrust cleared, for example, a check against PNC, and PNC's balance sheet after that decreased. So by providing the checkable deposits decreased, a loan was provided, the check was cleared, so it is 0, and here is checkable deposits 10,000 and the reserves 10,000. Next, we go to SunTrust Bank, which initially have 90,000 by clearing the check against PNC. And what happened, again, the same kind of thing which just happened with the previous bank in the line. And for now, its excess reserves is 81,000 because 10,000 should be placed in the Fed as the required reserves. And this 81,000 should be placed again in the economy, and this line, this sequence of events continues and continues. So let's calculate. If the proceeds of the loan, let's say, Howard barber shop, okay. There are different barber shops. There are different clients of the banks. Let's say that checkable deposits in the banking system, they arose by 81,000 by this amount. To this point, 100,000 initial reserves supplied by the Fed has increased the level of checkable deposits. Checkable deposits initially were 100,000 plus 90,000 plus 81,000. So they are 271,000 multiple deposit creation. This is what it is by just following the sequence of events. Once again, to understand the whole process, you start from the initial purchase and look what is happening in each step, how the checkable deposits changing, and you can see that the checkable deposits in PNC Bank, they are 100,000. Then the SunTrust Bank, 90,000. Then the other bank which will receive this 81,000, the checkable deposits will be 81,000. And that bank can also continue this line of events. So this is what we call multiple deposit creation. The money supply, again, this is not the monetary base. Now we are talking about money supply. Money supply is growing. With each loan provided by the bank, the money supply grows and grows. The initial increase in bank reserves and the monetary base results in the money supply growing by a multiple of the initial increase in reserves. So after that, let's call it third bank. Third bank received 81,000, increase in loans 72.9, it increased in reserves 8,100. Next bank 65,610. So 7.290 goes in reserves, the fifth bank, and so on and so forth. And total increase, if everything is okay, if we have 10% of required reserves, the whole process will continue until the total increase in deposits will be 1 million. Total increase in loans will be 900,000. And of course, total increase in reserves is 100,000. So that means initial increase in the reserves will be the ending increase in the reserves after the whole sequence of events continue. 10,000 plus 9 plus 8, 107 to 96, 561, and so on and so forth until it reaches 100,000. This is what we call the money multiplier. And of course, you should know what money multiplier is. Okay. So multiple deposit creation. This is what we, this is the process which I just demonstrated. So I think we have to make some pause for the video and then reconnect in 10 minutes. Okay. Have a break.